Let's jump right into this explainer because we have a huge financial mystery to unpack today. We're stepping into the shoes of a professional equity analyst to conduct a rigorous stock valuation on energy fuels, trading under the ticker symbol UUU. Our goal here? To reverse engineer the actual intrinsic value of a company when its traditional financial numbers seem to, well, completely defy gravity. We're going to rely strictly on the trailing data provided in their financial documents to run a full professional-grade valuation. Let's see what the numbers actually say. To do that, we'll follow a clear path. First, we'll lay out the analyst challenge. Then, we'll run absolute valuation, followed by relative valuation and asset valuation models. Finally, we'll synthesize everything into a final verdict. All right, Section 1, the analyst challenge. High price, negative cash. Looking at the data, the market is showing immense, almost dizzying confidence in this company. At a recent close price of $21.62, Energy Fuels commands a staggering $5.346 billion market cap. If we do a little reverse math, taking that market cap and dividing it by the share price, we get roughly 247 million shares outstanding. And get this, the one-year trailing total return on the stock is a jaw-dropping 376.73%. Clearly, investors are incredibly bullish. But here's the twist, and it's a twist that stops an analyst right in their tracks. While the stock has been rocketing to the moon, over the trailing 12 months, Energy Fuels burned through $141.27 million in free cash flow. They also posted a trailing net income of negative $85.6 million and a return on invested capital of negative 14.28%. This creates a massive reality gap. On one hand, you have a $5 billion market cap and a stock that's absolutely on fire. On the other, you're looking at deeply negative free cash flows and a negative 8.30% return on assets. So the real challenge today is, how in the world does an equity analyst build a rigorous valuation model when the trailing fundamentals are entirely disconnected from the soaring stock price? Well, we have to run the models to find out. Moving right into Section 2, Absolute Valuation, Future Cash Models. Now, as an analyst, one of the very first absolute models you'd reach for is the Dividend Discount Model, or DDM. This calculates the present value of expected future dividends. So what's the intrinsic value of Energy Fuels based on its dividend payouts? Well, we literally can't use it. Our source data confirms a 0% dividend yield and a 0% dividend growth rate. It turns out it's pretty impossible to discount dividends that just don't exist. So the DDM is a complete dead end here. We have to look elsewhere. Let's try another tool, the Discounted Cash Flow, or DCF model. A DCF projects the free cash flows to the firm and discounts them back to present value. Let's say we use a standard 10% weighted average cost of capital and a 3% terminal growth rate. But here is the massive reality check. Our starting point for trailing free cash flow is negative $141.2 million. To force this model to hit an intrinsic value of $21.62 per share today, you'd have to project a miraculous immediate leap from massive cash burn to hundreds of millions in positive cash flow. Based strictly on the historical data we have, a DCF model completely fails here. The assumptions required are just way too speculative.
Okay, what if we try the residual income model? This one is usually great for companies with messy cash flows. You start with the current book value of equity and add the present value of future residual income, which is just net income minus an equity charge. But guess what? We hit another wall. Since trailing net income is deeply negative at minus $85.6 million, projecting that trend forward would actually severely drag down our starting book value. It certainly wouldn't add to it. Bottom line, all three absolute valuation models fail to justify the current price based on trailing metrics.
Let's shift gears to Section 3, Relative Valuation Market Multiples. If absolute numbers don't work, maybe comparing them to the market will. Take a look at the sheer magnitude of these multiples. The trailing price to earnings is negative 55.44, and the forward PE is an astronomical 333.33. But the absolute shocker here is the price to sales ratio, 81.09, and an EV to sales ratio of 78.27. Think about what that actually means. Investors are literally paying $81 for every single dollar of revenue the company brings in. For context, their trailing 12-month revenue is just $65.9 million, yet the market cap is over $5 billion. To do a proper relative valuation, we need comparable companies. Since our source documents don't explicitly list direct peers, we have to make a sensible analyst assumption here. Against any reasonable publicly traded peer group in the traditional energy or mining sector, these multiples are stratospheric. Let's assume a healthy, high-growth mining or energy firm might trade at a price-to-sales multiple of roughly 5x and a forward PE of around 15x.
Applying those baseline assumptions makes the picture crystal clear. If energy fuels traded at that normal industry multiple of 5 times sales instead of 81 times sales, its implied intrinsic value would drop by over 90%. If it traded at a standard price-to-book of 2x instead of its current 7.66x, the value just plummets. Under relative valuation, using baseline assumptions, the stock is currently trading at an extreme thousands of % premium to its fundamental output.
So where does that leave us? Section 4. Asset valuation. Finding the floor. Let's find out what the actual assets are worth. To compute net asset value, or NAV, you sum up the fair value of all assets and subtract all liabilities. Our source document doesn't explicitly hand us the raw balance sheet, but it does give us the keys to unlock it. We get to play financial detective. We know the market cap is $5.346 billion, and we have a trailing price-to-book ratio of 7.66. If we do the math and divide the market cap by 7.66, we reverse engineer an implied book value, the net assets, of roughly $697.9 million. Then, we simply divide that by our 247 million outstanding shares. And that calculation gives us a definitive net asset value of roughly $2.82 per share. This is our hard floor. Based strictly on the provided metrics, if you liquidated the entire company today at book value and settled all debts, equity holders would be left with exactly $2.82 per share.
All right, Section 5, Synthesis. Let's establish our intrinsic value range.
When we pull all this together into a synthesis matrix, we really have to weigh the reliability of each model. The absolute models, they flat out fail. Projecting a DCF for a company burning $141 million a year to justify a $5 billion cap is highly speculative and has incredibly low reliability. The relative models offer medium reliability, basically screaming that the stock is at a massive premium compared to a standard mining baseline. So the absolute most reliable, hard number we have from these historical financial documents is that asset-based net asset value of $2.82 per share.
And that brings us to the final verdict. Giving the company the absolute benefit of the doubt and maybe assigning a small premium to book value for future potential, our modeled intrinsic value range sits squarely around $2.82 to maybe $5 per share. Yet it's trading at $21.62. Based strictly on the trailing financial documents, this stock is vastly overvalued compared to its intrinsic financial floor. The fundamental numbers just do not support the price.
Which leaves us with one incredibly provocative question. Is the market just completely irrational, blindly throwing money at a massive multiple? Or is there a massive future catalyst, like an upcoming uranium boom or a massive unpriced resource reserve that simply hasn't hit the trailing balance sheet yet? That right there is exactly what you need to research next. Thanks for joining me on this explainer, and keep questioning the numbers.